Investing can be exciting, but for new investors, it also comes with risks that can quickly drain your hard-earned money. Understanding how to manage these risks is crucial to protecting your investments and building long-term wealth. In this session, we'll explore simple yet powerful risk management strategies designed specifically for beginners, so you don't lose your money and can invest with confidence. Let's dive in and learn how to keep your money safe while growing it smartly. Today we will talk about Don't Lose Your Money, risk management for new investors. So before we start, make sure to hit the like button and subscribe to my channel. 1. Don't lose your money, risk management for new investors. Investing for the first time can be both thrilling and intimidating. The promise of growing your money is exciting, but the reality is that investing always carries risks. Risks that can wipe out your hard-earned savings if not managed properly. For new investors, understanding risk management is essential to not only protecting your capital, but also building a sustainable path toward financial growth. This article breaks down everything you need to know about managing risks in investing, helping you navigate the markets with confidence and avoid costly mistakes. 2. Understanding investment risk, the foundation. Before diving into strategies, it's critical to understand what investment risk actually means. Simply put, risk is the chance that your investment's actual returns will differ from your expected returns, including the possibility of losing some or all of your money. Risks come in various forms: market risk, price fluctuations due to economic or political factors, credit risk, risk of a borrower defaulting, liquidity risk, difficulty selling an asset quickly without loss, and inflation risk, the erosion of purchasing power over time. New investors often underestimate these risks or overestimate their ability to tolerate losses, which can lead to panic selling or poor decision-making. A key part of managing risk is recognizing that some risk is unavoidable. No investment is completely safe. Even government bonds, considered low risk, carry some inflation and interest rate risk. Therefore, instead of seeking to eliminate risk, the goal should be to understand and control it within your comfort zone and financial goals. 3. Set clear financial goals and risk tolerance. Effective risk management starts with clarity on your personal financial goals and risk tolerance. Ask yourself, what am I investing for? Is it a short-term goal like buying a house within 5 years, or a long-term goal like retirement in 30 years? Your timeline heavily influences the type of risks you should take. Generally, longer horizons allow more risk since you have time to recover from market downturns. Equally important is assessing your risk tolerance. How much volatility or loss can you emotionally and financially withstand without losing sleep or making rash decisions? Tools like risk tolerance questionnaires or consultations with financial advisors can help you gauge this. Remember, risk tolerance is personal and may change over time based on life circumstances. Aligning your investments with your risk tolerance helps prevent panic reactions that often lead to locking in losses. 4. Diversification. Don't put all your eggs in one basket. One of the most fundamental risk management strategies is diversification, spreading your investments across different asset classes, sectors, and geographies. This reduces the impact of a single underperforming investment on your overall portfolio. For example, if you invest all your money in one company's stock and it crashes, you could lose everything. But if you diversify across stocks, bonds, real estate, and even different countries, losses in one area may be offset by gains in another. Diversification isn't just about quantity but quality too. Consider the correlation between assets. Ideally, they should behave differently under various market conditions. For instance, bonds often perform well when stocks decline. Exchange-traded funds, ETFs, and mutual funds offer convenient ways to diversify even with small amounts of capital, giving new investors access to a broad range of securities without picking individual stocks. 5. Use asset allocation to balance risk and reward. Closely related to diversification is asset allocation, deciding what percentage of your portfolio to invest in various asset categories based on your goals and risk tolerance. This strategic distribution plays a pivotal role in managing risk. A more conservative investor might allocate a larger portion to bonds and cash equivalents, which are typically more stable but offer lower returns. Meanwhile, a younger investor with a longer horizon might have a higher allocation in equities, accepting greater short-term volatility for potentially higher long-term gains. It's important to periodically review and rebalance your asset allocation, as market movements can skew your original plan. Rebalancing involves selling some assets that have grown disproportionately and buying others to maintain your target allocation. This disciplined approach helps you buy low, sell high, and keeps your risk exposure aligned with your comfort level. 6. Implement stop-loss orders and other protective tools. In addition to strategic planning, new investors should consider tactical tools that help manage downside risk. A stop-loss order is a popular risk management technique where you set a predetermined price at which your stock or investment will automatically be sold to prevent further losses. For example, if you buy a stock at $50, you might set a stop-loss at $45. So if the price falls to that level, your shares are sold before the loss gets worse. Stop-loss orders protect against emotional decision-making during market volatility but should be used thoughtfully, as markets can be temporarily volatile and trigger these orders unnecessarily. Other tools include limit orders, which allow you to specify the price at which you want to buy or sell, and hedging strategies using options or inverse ETFs for more advanced risk control. 7. Stay educated and avoid emotional investing. One of the biggest risks new investors face is reacting emotionally to market swings. Fear and greed can drive impulsive decisions, selling in panic during downturns or chasing hype during bubbles. Education is your best defense against these pitfalls. Learn the basics of investing, understand how markets function, and familiarize yourself with historical market cycles. Recognize that volatility is normal and short-term losses don't necessarily mean permanent damage. Consider setting rules for yourself, like not checking your portfolio daily, having an emergency fund to avoid selling investments in a crisis, and sticking to your investment plan regardless of market noise. Remember, investing is a marathon, not a sprint. Patience and discipline are key to managing risk successfully. 8. Seek professional advice when needed. While it's great to learn and manage investments independently, new investors should not hesitate to seek professional guidance, especially when starting out or facing complex decisions. Financial advisors can help tailor a risk management plan to your specific goals and circumstances, recommend appropriate asset allocation, and provide emotional support during turbulent markets. Be sure to choose advisors with fiduciary responsibility, those legally obligated to act in your best interest, and understand their fee structures to avoid conflicts. Additionally, many robo-advisors offer low-cost automated investment management with built-in risk controls, making professional help more accessible for beginners. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.